More than half of U.S. homes lost value this year. Not a headline from 2008, but what's happening right now. Here's where prices are slipping, why condos in places like Florida are getting hit hard, and what it means for buyers and sellers in 2026. Over the last year, the U.S. housing market quietly crossed a turning point. Zillow's latest research shows that 53% of all U.S. homes have lost value compared with a year ago, based on their Zestimate home value index. That's the highest share of homes with year-over-year value declines since 2012, when the last housing crash was bottoming out. Nationally, though, prices on average are basically flat, up only about 0.2% year-over-year as of late 2025. So the headline is not prices are collapsing, it's the boom is clearly over. Instead of everything going up all the time, more than half of homeowners are seeing their estimated value slip a bit, while the national average just kind of moves sideways. Here's the key difference from the last crash. Even though values dipped over the past 12 months, most owners are still way ahead. Zillow's data show that only about 4.1% of homes are worth less than their last sale price, and the median homeowner is still up about 67% since they bought, on average, roughly 8.5 years ago. That's a huge equity cushion compared with 2008. So if your home's online estimate is down this year, you're not alone. And it usually means you're giving back a slice of the pandemic gains, not erasing a decade of appreciation. Now, let's talk about where this cool down is hitting hardest, because it's not evenly spread across the country. A lot of the sharpest value drops are in the same places that ran the hottest during the 2020 to 2022 boom. Think Sunbelt and Western metros that saw double-digit appreciation year after year, markets like Denver, Austin, Phoenix, Dallas, and parts of California. In Denver, for example, local reporting highlighted that the metro leads the nation in broad-based value declines, with a very high share of homes seeing their Zestimate fall year over year. That's a big flip from just a few years ago, when buyers were lining up and bidding wars were the norm. Regionally, the divide is clear when you zoom in on price per square foot. Realtor.com's 2025 data shows that listing prices per square foot actually fell about 2.4% in the South and 1.4% in the West year over year, while they rose about 4.4% in the Northeast and 1.8% in the Midwest over the same period. So a lot of the pandemic-era winners are now the ones giving back ground, while many slower, more affordable markets are still inching upward. A big driver of this cooldown is simple supply and demand. On the supply side, active listings have been rising for more than 2 years in a row. Realtor.com's December 2025 report shows that the number of homes actively for sale was about 12.1% higher than in December 2024, marking the 26th straight month of year-over-year inventory growth. So compared with the COVID bidding war days, buyers now have more options. But that doesn't mean we're flooded with homes. Even after that increase, total inventory is still roughly 12.5% below typical 2017 to 2019 levels nationwide. So we're no longer in historic shortage, but we're not fully back to pre-pandemic normal either. Under the hood, it's very uneven. In parts of the South and West, inventory has rebounded the most. Some Sunbelt markets like Austin and Denver now have active listing counts at or above their pre-pandemic norms, and homes are sitting on the market longer. In contrast, many Northeast and Midwest metros still have relatively tight supply, which helps support prices. So, depending on your zip code, this can feel like either a buyer's market emerging or still a pretty tight, competitive situation. On the demand side, higher borrowing costs and overall affordability are still the main brakes on the market. Mortgage rates have come down from the peaks we saw in 2023, but nowadays, a typical 30-year fixed rate is still sitting in the low 6% range, well above the 3 to 4% environment buyers enjoyed in 2020 to 2021. That difference translates into hundreds of dollars in additional payments at the same price point. Multiple data sets show that while purchase mortgage applications have improved from their lows, they're still well below pre-pandemic levels. CNBC, citing Mortgage Bankers Association data, reported in 2025 that purchase applications were running roughly 30 to 40% below comparable 2019 levels, even after some rate relief. Data from one of the largest mortgage and housing data sets in the country maintained by Intercontinental Exchange, show a similar pattern, with purchase activity well below its 2018 to 2019 averages. So there are buyers out there, but demand is fragile. It tends to pick up quickly when rates dip and cool just as fast when rates tick back up. That's a very different feel from the frenzy years, when anything priced even close to reasonable would get a crowd. Now let's look at one of the biggest splits in the market right now: condos versus single-family houses. Nationally, data from Intercontinental Exchange's Home Price Index, along with other analyst reports, show that U.S. condo prices have seen their largest annual decline since 2012, with prices down roughly 2% year over year in late 2025. Meanwhile, single-family home prices, on average, have been close to flat to slightly positive over the past year, depending on the index you look at. So condos are clearly under more pressure than detached homes. There are a few big reasons for that: rising ongoing costs, HOA fees, insurance premiums, and special assessments have spiked in many buildings, especially older ones that now face stricter safety and reserve standards. Financing and insurance hurdles. Some lenders and insurers have become more cautious about certain condo projects, which shrinks the buyer pool for those units. Shifting buyer preferences. Post-pandemic, more buyers are prioritizing space and flexibility. If they can work remotely, that small urban condo looks less attractive compared with a townhome or single-family home in a lower-cost area. These issues exist nationally, but they're most extreme in a few key states, especially Florida. Florida has become ground zero for the condo downturn. Analysts tracking the state report that Florida condo values are down about 9.9% year over year, the steepest one-year drop since the aftermath of the late 2000s housing bust. In some metro areas and submarkets, local reports show price declines in the low to mid-teens for certain condo segments. At the same time, condo inventory in Florida has surged. Some estimates put months of supply well above the 6-month line that usually marks a balanced market, firmly in buyer's market territory for many buildings. Florida Realtors data show the statewide median price for condo townhouse properties in Q4 2025 at about $300,000, down 4.8% from a year earlier, even as single-family homes held up better. A big piece of this story is costs. Insurance premiums have skyrocketed across much of the state, especially near the coast. On top of that, post-Surfside safety rules are forcing many older buildings to complete expensive repairs and build up reserve funds, driving HOA fees and special assessments sharply higher. For some owners, those rising monthly and one-time costs are simply too much, and they're listing their units at the same time, pushing inventory up and values down. If you're buying or owning in this segment, the building's financial health matters just as much as its list price. While Sunbelt condos and boomtown markets grab the headlines, many lower-priced metros in the Midwest and Northeast are quietly holding up. Because these markets never saw the same 30 to 40% pandemic run-ups as places like Phoenix or Austin, there's less air to come out of prices now. Realtor.com's analysis shows that on a price per square foot basis, the Northeast and Midwest continued to see modest year-over-year gains through late 2025. Even as the South and West turned negative. Specific metros like Milwaukee and parts of upstate New York have shown that pattern. Inventory has increased, but not to the point of oversupply, and prices are still rising, just at a more reasonable pace. These are the boring but steady markets that don't blow up on the way up and don't crash on the way down. If you're a buyer in those areas, you may not get big discounts, but you also don't face the same volatility risk as in some boom and bust markets. If you're an owner, that slow, steady appreciation can be exactly what you want over the long term. Let's talk about those online value estimates that everyone checks: Zestimates and similar tools. Zillow actually publishes pretty detailed accuracy stats. For currently listed homes, Zillow reports a national median error of about 1.9% between the Zestimate and the final sale price. For off-market homes where there's less up-to-date information, the median error is around 7%. So on a $400,000 home, you're typically looking at plus or minus about $8,000 if it's listed. and plus or minus roughly $28,000 if it's off-market. That's good enough to spot the trend, but not precise enough to replace an appraisal or a solid CMA from an experienced local agent. The accuracy is also better in high turnover, data-rich markets, and weaker in rural areas or for very unique homes. So your individual number may be off by more or less than those typical ranges. But here's why the 53% of homes lost value stat is still meaningful. When you aggregate millions of properties into metro, state, or national level indexes, those individual errors mostly cancel out. The odds that a shift that big is just noise are extremely low. In other words, you can debate your exact number, but the direction of the market at the broader level is pretty clear. So zooming out, where does all this leave us heading into 2026? Putting the data together, the story looks like this. More than half of U.S. homes saw value declines over the last year, but national prices are roughly flat on average. Inventory is higher, about 12% more homes for sale than a year earlier, and more than 2 years of consecutive inventory gains, but still around 12% below 2017 to 2019 normal levels. Demand is present but softened. Purchase mortgage applications are still running well below pre-pandemic averages because of higher rates and stretched affordability. Condos, especially in high-cost states like Florida, are taking the biggest hit with the largest annual price declines since 2012 and much higher inventory. More affordable markets in the Midwest and Northeast with modest supply are, for now, holding up better, with small year-over-year price gains instead of declines. That's a textbook cooldown, not a 2008-style crash. Back then, we had a flood of inventory, extremely loose lending, and a wave of distressed sales that quickly dragged prices down. Today, lending standards have been much tighter for over a decade. Most owners have fixed, low mortgage rates, and there's still not enough housing overall in many parts of the country. Could a recession or a sharp jump in unemployment change that story? Absolutely. That's the wild card to watch. But based on the current data, we're seeing a market coming off a sugar high and moving toward a more balanced state. Let's bring this down to your level and what it actually means for you in 2026. If you're a buyer, in many Sunbelt and Western metros, you have more negotiating power than at any time in the last several years. Inventory is up, days on market are longer, and price cuts are more common, especially on condos and on homes that were ambitiously priced. This is a good time to be patient. Write strong yet realistic offers and focus on total cost, mortgage, taxes, insurance, and HOA or condo fees, not just the sticker price. If you're a seller or homeowner, you're selling into a very different environment than 2021. You can't just name your price and expect 10 offers on day one in most markets. Pricing correctly against recent comps and being ready to negotiate on terms, repairs, or closing costs is key. If you own a condo in a high-cost or high-insurance area, staying on top of your building's finances, reserves, and upcoming assessments is crucial because buyers are paying close attention. If you're just watching the market, the most likely path from here is continued normalization. More markets shift from seller-friendly to balanced. Growth slows or turns slightly negative in overheated areas, and more affordable metros keep putting up modest gains. All right, that's where the housing market really stands heading into 2026. Not a crash, but a clear cooldown, with some big winners and losers depending on your market. What are you seeing on the ground where you live? Drop your city and your experience in the comments so we can all learn from each other. If this helped you make sense of the headlines, hit like, subscribe, and tap the bell so you don't miss the next market breakdown. Thanks for watching, and I'll see you in the next one.